Hello. This is the core summary note of ChoWorld. In the first topic, we will examine the risks of U.S. debt that Ray Dalio has warned about. The United States is currently recording a fiscal deficit of about 7.5% of its GDP. If the issuance of government bonds surges to cover this deficit, the supply-demand balance for bonds in the market may collapse. As a result, interest rates rise, increasing borrowing costs for businesses and households, which can burden the overall economy. In particular, the larger the scale of debt, the more sharply federal government interest expenses skyrocket, with even a slight increase in interest rates, making this a key risk factor. China, Japan, Europe, and other major economies also face significant deficits and debt. This issue is not limited to the United States. As government spending is expanded by measures such as tax cuts to stimulate the economy and increased welfare expenditures, problems arise when there are not sufficient plans to secure tax revenues. As a result, the government bonds issued by each country consistently increase, placing a burden on the global bond market as a whole. In particular, as Dalio emphasizes, political conflict or failure to reach agreements among major countries can further amplify interest rate volatility and currency risks. Concrete measures to reduce the deficit to substantially reduce the fiscal deficit. A comprehensive approach considering tax increases, spending cuts, and economic growth promotion is necessary. If taxes are raised significantly, corporate and individual activities may shrink, and if spending is drastically cut, social welfare and infrastructure investments could be undermined. Therefore, the most important thing is to achieve a medium to long-term balance through political consensus. If a divided Congress or leadership fails to reach an agreement, the debt level may continue to accumulate, leading the market to drive interest rates sharply higher on its own. Ray Dalio proposed a 3% solution to reduce the U.S. fiscal deficit from 7.5% to 3%, considered historically stable, and is said to prevent a surge in interest rates due to a flood of government bonds. If the deficit is reduced to the burden on the market from issuing government bonds would lessen, and the pressure for interest rate hikes would likely ease. Furthermore, if interest rates stabilize, the federal government's interest expenses would decrease, leading to a virtuous cycle of healthier public finances. In the bond market, when interest rates rise, the stock market is also immediately affected. Treasury yields serve as a global financial benchmark, often referred to as the backbone. When rates rise, equity valuations, considered risk assets, tend to decrease, and investors may move funds into safer government bonds. From a corporate perspective, the burden of loan interest increases, potentially curtailing investment and hiring, which in turn can affect overall economic growth. Recently, companies in the tech and AI sectors have maintained high price-to-earnings P/E ratios due to expectations of rapid growth. However, when interest rates rise, the discount rate on stocks that have already factored in future value increases, which can significantly drive down their prices. Even so, Dalio believes that the potential for efficiency improvements across industries and the creation of new markets through innovative technology cannot be ignored. Therefore, when evaluating technology stocks such as AI, both current valuation and long-term growth potential should be considered. According to Dalio, the market has not fully factored in the real economic impact of the application stage of AI. AI can be integrated into almost every industry: finance, manufacturing, logistics, healthcare, education, and so on, potentially leading to rapid improvements in productivity and profitability. Major powers like the United States and China are intensifying their AI race, which has the potential to reshape the global market structure. Therefore, one should not only look at the current revenue of AI companies, but also pay attention to their long-term application, potential, and pace of innovation. Bonds essentially function like money, but if excessive debt accumulates, the currency's value itself can become unstable. Dalio advises considering investments in alternative assets like gold to mitigate such risks. If the market's confidence in government bonds declines, it could lead to inflation or currency depreciation, at which point gold or other tangible assets can serve as a relative safety net. Meanwhile, some alternative currencies, such as cryptocurrencies, are emerging, but due to their high volatility, comprehensive risk management is essential. That's all for this summary. If you subscribe, you can access the next summary that will help with your investments.